Welcome to the 30th episode of Lunch Money. My name is Nick Samios, and you've tuned in to the online and social media home for special situations, workouts and capital raising professionals. Australia's economic cycle is very much dependent on the mining and property sectors, and today we're going to be getting some special insights in both mining and property development from leading industry insiders, property development funder Solido Capital's Michael Corcoran and equity specialist and corporate advisor Nick Brownbill from JP Equity Partners. Meanwhile, there is an expectation of a wave of corporate insolvencies at some point in the future. Exactly when in the future that is, we don't know. And when that happens, hopefully we'll also see a wave of business reconstructions and business turnarounds. Already Virgin's reconstruction and turnaround is in the news again today, with talks of industrial relations being a potential impediment to Virgin's turnaround plans. And we'll talk a little bit about some of the aspects of that with Ryan Eagle, who is a partner at KPMG and a restructuring and turnaround specialist. First, a quick reminder to subscribe wherever you're watching us or listening to us. YouTube, give us a subscribe. Secondly, a reminder that the best question receives this mug. I don't actually have the mug in my hand. I meant to get that. I don't have that prop, but we've got the Lunch Money mug, and the best question that we receive live today, we'll send you a Lunch Money mug. The runner-up last week was a wag who asked, "Where's my mug?" That's not the kind of question we're looking for. We're looking for a question that we can put to our panel. Okay, without further ado, I caught up with our first guest, Nick Brownbill from JP Equity Partners on Sunday. I was at home, so the lighting was a little bit different, and I was in my lounge room at home. Nick was at Perth Airport and on his way to Diggers and Dealers. Okay, we've got Nicholas Brownbill, Director and Corporate Advisor with JP Equity. He's in the departure lounge at Perth Airport, headed for Diggers and Dealers. G'day, how you going, Nick?
Yeah, very well, thanks, Nick.
Just a couple of questions. Firstly, what is Diggers and Dealers for our East Coast viewers?
So Diggers and Dealers is a once-a-year mining conference over here in Kalgoorlie, Western Australia. So it's basically a three-day mining conference, and we have a range of companies that usually come from all around Australia to present. Have a mix of fund managers and stockbrokers from the industry. So it's a big event in the calendar over here.
And I have had a look at the schedule. You guys very kindly invited me along, but I'm stuck here in New South Wales. I had a look at the schedule. It's not exactly. I'm sure you'll have time to have some fun, but it looks pretty heavy going. This is a shot of you guys flying over there last year. What's going on there?
Yeah, so last year we JP Equity, obviously the firm that I'm with, alongside Jane Morgan Management, we organised a chartered 100-person plane to Kalgoorlie. We have 10 corporate sponsors, a range of mining companies that come on board and present to the fund managers / brokers on board. So it's a really good opportunity for these companies to get a bit of a jump start on getting in front of a few, or getting their story out there prior to the actual conference starting. So this is the second year we're doing it. There's obviously some good numbers here already. We'll be departing in about half an hour's time, so it does us good.
Fantastic. And they actually pitch on the plane. You have a little pitch session on the plane, I understand.
Yes, correct. So each row has one corporate per row. Obviously, they will be chatting to those brokers on board. It's a 45-minute flight, so there's not too much time to do too much seat swapping, but it's a good opportunity for the guys to get a story in front of the.
Sounds excellent. Now you are going to Cal. This is the All Ordinaries Gold Index, Gold Miners Index, versus the All Ords. So I mean, they've obviously both bounced back since the lows back there in March and April, but gold has done really well. So the mood should be pretty good.
Yeah, I'm expecting the mood to be, always is pretty upbeat. Diggers and Dealers, pubs are always firing, but obviously this year, it would be just West Australian people that'll be going to it, and expecting it to be quite buoyant, which is reflecting what's been happening in the market.
And is there any particular buzz this year? Any sort of hot topic?
I think obviously gold, lots of explorers, and I think also I guess the Northern Star Saracen merger last week, which will be a lot of talk of the town. So.
And is there anything, I know obviously you guys specialise in the actual miners. Is there anything you can tell us about mining services? I mean, obviously it's picked up along with mining generally.
Yeah, no, the mining services is picking up as well. We've recently been involved in a company that listed, and they're experiencing significant demand for all their services. They're a drill and blast company, Dynamic Drill and Blast, and since they've come listed and on the back of the market, they're noticing lots of inquiries. So
very good. Yeah, I know. There was a time a few years ago when everything was in the doldrums that you couldn't give away a drilling rig for love or money, and then when it all came back again, you couldn't buy them anywhere as well. Listen, I know that you're in the waiting lounge here, so I'll just ask you one last question. Have you got any capital raisings on the go that you can tell us about?
We actually do. We've actually lodged a West Australian KLN is the company that lodged their prospectus for an IPO on Friday. So they'll be raising a $22 million at $55 million market cap. So JP Equity is co-manager for the IPO alongside Canaccord. This is a really exciting company. This guy's a West Australian base. It's a tier 1 KLN deposit. They have a DFS in place. They've got all the mining approvals, and they're raising money to basically get the mine into production and become a globally significant KLN producer.
Fantastic. Okay, well that's very exciting. Maybe we can get you and them on our show in a couple of weeks if that's something you can organise. That'd be fantastic.
Yeah, that'd be good. The timing will work out well.
All right. Okay. Listen, I'll let you go. Have a great Diggers and Dealers, and thank you very much for joining us.
All right, cool. Thanks, Nick.
Thanks a lot, Nick. Cheers. Bye-bye. Well, the age-old question, of course, is what's better than one Nick? And the answer is two Nicks. So thank you very much to Nick Brownbill. And keep an eye out on our schedule because we will hopefully have Nick back on live with that to tell us about that particular capital raise that he's doing with hopefully the CEO or some executives from that firm, which should be very good. But right now, it's time to introduce our first panellist, Michael Corcoran. There he is. Michael, how you going?
Very good, Nick. Very good. Thank you for inviting me on.
Fantastic. Now, Michael, you're the Executive Director at Solido Development Finance. So tell us a little bit about what it is, what Solido is, and what is it that's been keeping you busy the last little while.
So Solido Capital Development Finance is focused on filling the gap left by the banks for providing development finance, predominantly senior development finance, first mortgage secured to developers across Australia. We focus on the residential market. I've got a 30-year history in development as opposed to just financing all over Australia in the development market in residential development. So we have a team of people that are experienced, if not more experienced in development as well as financing. And we saw that there was a gap forming as the regulators pulled the banks back from around a 90 to 95% market share in Australia of providing development finance to developers. And we launched the company about 4 years ago. We have our own balance sheet of around just over $60 million. We use that capital to underwrite all of the development financing facilities that range from around 5 million through to about 25 million in scale. And then we sell down those investments up to 75% of those investments, maintaining 25% on our own balance sheet for strong alignment with our investors, which is quite unique amongst non-bank lenders, to wholesale investors. We have an AFSL license. We deal with small wholesale investors through to family offices and some institutions who invest into our facilities. They earn around 8 to 10% returns to the investor. And we see them as secure investments with strong returns. So they're first mortgage secured, and most people know about the security that runs with that sort of investment. And generally the loan to value ratios or the exposure of our investment capital is around about 60 to 65% maximum of the value of the asset that we assess. So We've been very, very busy, busier than this time last year. We've got around about 60 million in construction projects completing at the moment in Melbourne and Sydney, with facilities coming back over the next 2 or 3 weeks, the settlements of those end projects complete. And we have around about 50 million in site acquisition facilities that are converting through to refinancing for construction finance. So we've got a lot of facilities and capital coming back in, and pleasingly, we have a strong sense of where our investors sit. There's at this stage, it looks like most of those investors want to reinvest, and we're looking and assessing around about $120 million of new facilities right as we speak. So you are looking at me sitting in a car, because I've been running around doing site inspections this morning, one at Fairlight in Sydney, one at Newport in Sydney, and various others, assessing, completing the due diligence, preparing them to be underwritten by ourselves and then sold down to investors. So a very busy period between now and Christmas. The other thing that's kept me busy this week, which is quite interesting, is I've got relatives in Adelaide, and I was down in Adelaide for a couple of days. So I got an insight into what a city looks like when there is no COVID, which is essentially the case in Adelaide, and also the attitude of the people. And if anyone thinks that people aren't going to go back into work in CBDs, head into Adelaide CBD, because it was packed and very normal.
All right. Well, you've preempted a little bit of what we'll talk about in a little while. There's so many things I'd like to ask you about. It's a very interesting model that you have there about investing first and selling down, and so that's very interesting. And obviously, you're sort of characterising yourself as someone with property development experience first and a lender second, which I'm sure the investors would love as well. Listen, we're going to just pop you in our waiting room, Michael, while we introduce our next guest, who is Ryan Eagle, partner, deal advisory, restructuring and turnaround at KPMG. G'day, Ryan. How you going?
Very well, thank you.
And what's been keeping you busy the past week or two?
Yeah, I mean, it's been an interesting environment from a restructuring point of view. With the level of government stimulus, it hasn't been anywhere near as busy week on week as we would expect. But we expect that will change over the course of next year as the stimulus comes off. But where we are getting involved is where there is stress or dispute amongst parties. Michael mentioned the level of capital we're seeing, particularly in property matters, that there is quite a lot of capital, alternative capital, to come in and solve stress situations. Certainly the big four Australian lenders are not driving outcomes. It's more alternative lenders coming in and assisting. But there still are stress situations, whether it's a joint venture dispute or a dispute amongst the equity holders, that are situations that we're getting involved with. There's probably 3 that we're handling at the moment where there's a dispute both amongst the equity holders and that then goes through to the debt as well, where equity are not looking to put more money into a project, and at least one we've come in on an enforcement basis, and there's a couple of others that we're working closely with the stakeholders, trying to find a way through it. But ultimately, in some cases, there will be enforcements. But generally, at this time of this unusual cycle we're in, the enforcement levels are historically low, as has been widely reported.
Yeah, it's very interesting. I mean, the very fact that you're even using the word enforcement, you just don't even hear it spoken of late. I imagine that you're talking about, disputes amongst stakeholders. I guess I suppose with COVID, everybody needs to. It puts pressure on relationships, doesn't it?
Yeah, it does. But surprisingly, everyone's quite collegiate in the way they're going about things at the moment, and there's also this sense of a wait and see attitude. But from time to time, you're right, it does flare up and create tension.
Yeah, and you're speaking to us from the office, so I guess
Yes.
your team is back. Are they partly working from home? What's happening there?
We're accommodation, so we have a booking process where it's sort of only one in every two desks can be used, but generally people sort of 50% in, 50% at home. So
Yeah.
it's a it's a relatively fluid working situation depending how busy we are. We are out on site from time to time, certainly in Sydney, but our Melbourne colleagues are locked away. But hopefully, as Michael said, everyone gets back into the cities before long, and we can keep those real estate values up, as we'll talk about further.
Yeah. Well, it's going to be interesting to see if it starts raining insolvencies. I wonder how many. I wonder if this 50-50 thing will hold up. But we'll go. We'll bring Michael back, and we'll start having a look at some of our headlines. Starting off with this article here: insatiable growth vanishes in big cities as workers move away. And this is talking about, I guess, a couple of things. People moving away from the city, either to the suburbs or into regional areas. I mean, Michael, you're in the property development game. Are you seeing this, and how's that influencing the decisions that you make as a property developer or property development lender?
Oh, look, I think the first thing I'd say is the media loves sensational headlines.
Right.
I think that headline's a bit of a stretch. I think, I was down in Adelaide, and they've had a very stable situation all year. I wouldn't have seen any difference in the numbers, the volumes of people. I met with a lot of colleagues down there. They are all in the office. Some of them might like to be in the office less, but really their operations are operating as they were before. I think that we will see more of that. Sydney is still quiet as a CBD, and all the support, food halls and everything around it. But I think, I can't speak for you, but I've enjoyed being at home. But I enjoy being back in the office as well, and having that break away from that environment. And Ryan, you mentioned the word collegiate. That is something that's essential. Getting a team together, getting together with clients face to face, and we're finding that our scheduling as a company in an office is less about just the routine of being there every day, but being more event driven. And certainly we're seeing a benefit of results from getting together as a team, getting together with our clients, and I think that that ultimately underpins whether demand for offices, and even the people thinking, oh, I don't need to live near my office anymore. I can live, in a regional location or a beach location a long way from the office. I think that will stabilise as well. Property always sees new trends come in, the pendulum swings, and generally it comes back and balances out in time. I think we'll see that. What I do think will happen is there will be some changes in how offices are configured to suit, some of those reasons to be in the office. So, I think underlying demand will still be there. We might not be building as many offices in the future. There might be some C and D grade offices, D grade offices that suffer in their current configurations that need to be renewed or knocked down and rebuilt. But I've got great confidence that the pendulum will swing back and there'll be a bit of normality come back in next year and the year after.
And Ryan, I mean, sort of offices are one thing, but I'm just wondering about residential developments, for example. I mean, my office is here in Waterloo, and
Yes.
I've been here for 10 years, and we've seen one residential apartment block go up after the other. But would you be concerned, or would the bankers that you deal with be concerned about getting those developments away at this stage? Or
Look, I'd say on the bankers that they're certainly, I'm not sure the word concerned is the right word, but they're certainly giving it quite a lot of thought as to what new trends are going to play out, and agree with Michael that the pendulum will come back, but there will be some changes, and certainly that's a thought that's been considered. It really drives, a lot of it is that those apartments that you talk about that are going up, and their access to transport and ability to get around. So if there's more office hubs take Sydney, for instance, in different locations. It's just about being able to access them via different routes. I know that our firm, as a larger organisation, we have 5 offices around Sydney, and you can book and go to any one of those offices. So, we have the luxury of being able to use different transport routes. For smaller organisations, it is a little difficult, but I think a lot of effort's been put into the Sydney infrastructure. It's improving to allow those different office hubs. Certainly, I think that's the same around different parts of the country. But the major CBDs will still attract a lot of people. We certainly have a view that booking systems will be something, and different configurations of offices, and which might change the total demand. But from a long term, the demand's still going to be there.
Okay. Well, just okay. Well, that's interesting. Long term is one thing, of course. You've got to make it to the long term. Whether or not there's a valley of death. Our next couple of headlines, I guess, in the same vein. Tower values hit as virus infects vacancy. Commercial property deals down 58% as industrial surpasses office. Michael, obviously you do a lot in the residential space. Do you do much in commercial?
No, but we focus on that area for good reason, and not just property, residential in general, but with the knowledge and the insight we have within the team and experience, we can then pick corridors that we favour the demand-supply balance and de-risk for our investors and our debt lending. But I'm very aware of the commercial market. I've worked with colleagues like Darren Steinberg, who's head of Dexus. I catch up with Darren reasonably often to get a sense of what's going on there. Look, I think that obviously in a time like this with uncertainty, and uncertainty is the enemy of risk management. And at the moment, of course, whilst things are uncertain, you'd expect transactions to be down. If they were up, that would probably suggest that a lot of the owners are highly distressed and having to sell. I think the fact that they're down probably gives a sense of comfort that there isn't, the panic selling going on, because there would be buyers there at the low values. The long-term investors that can see that it will stabilise. So, I'm not surprised to see those things. Look, industrial up is probably a lot related to the lift in demand for distribution. Whether that stabilises as walk-in retail sort of comes back and is de-risked, post-COVID. But certainly, Dexus launched a fund in recent times, an opportunity fund, and it's looking at things like taking retail centres and converting them to distribution centres because they can see some underlying long-term demand. But again, I think things will stabilise, and I think in some areas industrial is a bit overcooked and needs to settle.
I tell you what, I'm just going to go a little bit off script here because when I've been looking at these headlines, just listening to both of you speak, as a matter of fact, it makes me think of a couple of things. Firstly, from an investor's point of view, investors are yield hungry. We've got zero interest rates, who knows, negative interest rates coming up. So on one hand, you've got investors who are yield hungry. On the other hand, we've got the specialists like myself, but also like Michael and Solido Capital, who are very specialised. If you're going to play around in this property development space, I don't touch property development myself. I've always said, anyone comes to me with a property development proposal, I say, listen, it's just not me. There's too many other people that know about it, and you really need to be very specialised. I just wonder, Ryan, from your point of view. Do you find yourself dealing more and more with specialist funds?
Yeah, substantially. And there's a couple of points I'd make on that. One is the sophistication of capital has improved substantially since 12 years ago with the GFC. There's not just funds that come and solve problems. There's funds that do property development. There's funds that are opportunities funds. There's a handful of people that have a specific focus on any issue that we come across from a restructuring point of view. And Dexus with their opportunities fund, there's a number of other similar funds that are looking for ways to deal with assets that might need a change in their focus. So I definitely, that's been an evolving situation for us over the last 10 plus years, and we'll move substantially over the next year or two. It'll also change the way restructurings are undertaken. Certainly we expect to see a lot less formal enforcements and a lot more consensual restructurings, and whether it's a new lender working with existing lenders and some form of equity, but certainly there's a lot of different solutions available.
And Michael, do you see yourself? I assume that you get involved in developments from the ground up, but do you anticipate that maybe over the next 12 months you might get approached to take over developments? Maybe they're halfway through and they have hit problems, and you might get asked, by someone like Ryan or one of the banks to parachute in. Did you anticipate that at all?
Yes, I do, and I think, but ahead of that, what we see, the run up to the end of last year, pre-COVID, probably our biggest frustration was what you were talking about before, Nick, was the investors were all really obsessed with yield and really not focused at all on risk and who they were backing to invest behind and the experience and set that they've got to manage, to assess projects and acquisitions, but also, if worse comes to worse, to deliver those acquisitions. So we wouldn't go out and seek to acquire or work out a project unless we were a debt provider on it.
Right.
And the way we do our due diligence is as if we are 100% equity funding it, and we are the developer. We take that development type approach rather than just a debt provider approach. However, when we invest, there's a buffer of 35 to 40% on the capital value. That's extra security. So we're seeing it as a purple patch for us because of that experience, and we would expect coming back to that word collegiate that Ryan mentioned before. We've had challenges with some of our developers this year. But I can look through, our team can look through to see what's legitimate challenges and issues that are market related and what aren't, and then we can be flexible to work with them. And our investors have given us the flexibility, because of our experience, to do things like provide construction finance without having a stack of pre-sales on those projects, because essentially we've done our DD, but we believe there is underlying demand for the projects. And a bunch of pre-sales doesn't necessarily tick a box for us. It's that more detailed due diligence and confidence that if something went wrong, we could work through it and trade through it. So it's certainly a better time for a group that's got the experience we've got, rather than some of the financiers that don't have that depth of delivery experience.
Yeah, look, I'd love to talk to you about, I'm sure, we've been around for a long time, and I know that you've obviously got a wealth of experience as well. And sometimes deals cross your desk and you're being out-competed on them by someone who started up, yesterday. And you look at the deal and go, I know all the risks in this thing, and there's no way I'm touching it the way they want to touch it. But we won't go down that path right now because time is getting past. We've got, given that we've got Ryan, who is a restructuring expert, we have to look at some of the insolvency-related headlines. A couple of headlines here: zombies take their medicine as some companies accept reality, and COVID-19 could kill 160,000 small businesses in Australia, and that's coming from Judo Bank's analysis there. So that's quite. Yes. Quite alarming. I guess anybody who's watched a zombie movie, and I've watched many of them, knows that one thing that zombies love doing is they love to eat the flesh of the living. So I guess one thing I would like to ask you, Ryan, is you give advice to all sorts of businesses. What advice do you give to good businesses to help them avoid being eaten by zombies? When things do turn south in the new year.
Yeah, there's a whole range of things to think through, and you're right in terms of good businesses that are whether it's a key supplier or a key customer that may not be able to pay them. So it's about being clear in their communication with those stakeholders. That's what we would always say. It's important to get advice and understand your registration position and also the current legislation. The government has provided a huge amount of assistance, both from a stimulus point of view, but also the insolvent trading holiday, which goes through until the end of the year, and now the small business restructuring reforms, which will come in by the 1st of January. So what that's created is an environment where the rules there's a number of interim new rules in place. So it's important for everyone to understand those, and some of them haven't even been finalised in terms of those small business restructuring. So it's a matter of understanding it. That
I'm very interested to know from your point of view that there's a little bit of confusion as to what is exactly going to happen on the 31st of December. So at the moment, there's an insolvent trading moratorium. I mean, you can't trade like a drunken sailor, but you still, the fact is it's going to be you're more or less absolved of insolvent trading. We've got this safe harbour. I mean, come the 31st of October, 31st of December. I order from you on credit terms, not being insolvent, but maybe borderline. I'm in the clear at that point in time. But come the 2nd of January, or whatever the first trading day is, at that point, I've got to. What happens?
Well, there's two things. I mean, the small business restructuring reforms actually allow businesses to nominate that they're going to use that reform from 1 January, and they actually then get a 3-month extension of that insolvent trading holiday. So that will be something that may get used, but again, it's unclear as to how the final structure of that. But you're right. There's a whole range of businesses that sit above that $1 million liability threshold that may look to use the safe harbour provisions, and that's creating a bit of uncertainty. But surprisingly, like when it was supposed to expire at the end of September, it was surprising to us the level of complacency and the fact that the general view was it'll all be okay.
So do you take the view that you have to go into administration before the 31st of December to be protected, or not? Because that's a point of conjecture.
I would say our view is that safe harbour might be something you'd look at, and if you don't think you meet safe harbour, then it depends. We're not hard and fast on that.
Okay. Yeah. All right. Okay. I'm just conscious of time, and I do want to ask Michael. It's one thing, obviously, you've got the property development's one aspect, and you're secured and all the rest of it. But are you concerned at all about tradies and the subcontractors?
Look, I think in the short term, yes, I am. I think it's great to see things like the Home Builder Grant Scheme being released for stimulating the economy. The challenge is sometimes that the politicians want to get these things happening quickly, and so they set deadlines to drive.
I think we've lost Michael, so we'll just close out with yourself, Ryan. We will go to we'll very quickly wrap up with our next slide, which was sort of in your bailiwick in any case. Virgin's epic fight with unions. Now, I don't want to get into necessarily Virgin. It's not really a conversation about Virgin.
Yes.
But what I do find interesting, I know that you've acted, as we said earlier, you've acted for funds and hedge funds in the past. This does seem to be a little bit of a potential battle where capital fights with labour. I mean, the new money's come in, and they've obviously got a plan on how to make money out of this thing. Obviously, the labour, on the other hand, the workers are concerned about trying to maybe restore their previous lifestyles. What's your experience in trying to restructure when you maybe have these sort of industrial relations issues? And do you think this is something we're going to see more of?
I definitely think it's something that we'll see more of, and it's a key focus for us and for any restructuring. The employees, particularly when you've got a big employee base like Virgin Arian being another one, and others of similar ilk. It is key to communicate and give them some confidence. And when you've got those large employee numbers, you then have federal and state government attention. There's no one way to deal with those situations. We find that all the unions are very proactive in trying to work through problems and find a solution. But as you alluded to earlier, you're in a stress situation where there's limited assets and the outcome's not always going to be in everyone's favour. So it's really just about trying to find a common ground and trying to protect as many jobs as possible. But it may well be that protecting all the jobs doesn't solve the profitability of the business.
Yeah,
and certainly that's the fun tension. I mean, someone like an investor coming in is trying to get profitability.
Well, hedge funds aren't renowned for being soft and cuddly, that's for sure. So that will be interesting. I guess the other interesting thing is that with these restructures, particularly what we're going to see, hopefully we're going to see, as I said, there'll be a wave of insolvencies, but hopefully there'll also be a wave of restructures and business turnarounds. And given that we are in a new world, business models are going to need to pivot, or whatever the terminology you want to use, and that's not necessarily always going to suit the existing workforce, I guess.
No, and what I think's been good over the last few years is the voluntary administration process has been used quite a lot to restructure businesses. With Virgin being an example, we've had McWilliams this year, Techfront, another business that we've used the voluntary administration process. So, with less receivership appointments having been occurring in recent years, the voluntary administrations have resulted in often the majority, if not all employees being continuing to be employed by the business. And it may be that it's a smaller business or a reshaped business, but jobs are preserved where they can be.
Okay. All right. Well, look, on that positive note of jobs being preserved, we'll wrap it up. And I would like to thank all of our guests, Nick Brownbill, who I spoke to earlier in the week, Michael Corcoran, who unfortunately one of the hazards of being actually in the field is that sometimes the connections fail us eventually. But thank you very much, Michael, if you can still hear us. Really appreciate your input. And Ryan, it was fantastic to have you along. We've been trying to get you along before now, but I really appreciate you making the time. Thank you very much.
Not a problem. Thanks, Nick. Well done.
All right. Thank you. And thank you very much to our viewers and listeners. See you next time. Cheers.